In this segment, we will look at special journals that are used within an accounting information system. Special journals are really broken out into the sales journal, the cash receipts journal, the purchases journal, the cash payments journal, and the general journal. The sales journal is used to record all sales of merchandise on account. The cash receipts journal is used to record all cash received, so any transaction that involves the receipt of cash. Purchases journal is used to keep track of and record all purchases of merchandise on account. The cash payments journal is where we record all transactions involving the payment of cash. And finally, the general journal is used pretty much for any transaction that does not involve sales on account, cash receipts, purchases on account, or cash payments. Basically, if a transaction doesn't fall into one of those four categories, then by default, we record it into the general journal. The special journals, the reason we use them is it substantially reduces the number of journal entries that we have to make in the general journal. And it really kind of keeps the accounting system a little bit decluttered. Only transactions that cannot be entered into a special journal are recorded in the general journal, and that includes any correcting, adjusting, and closing entries. All of those would go into the general journal. Here's an example of a sales journal. Here we are seeing during the month of May all sales that were made to customers on credit. Notice that each individual sale is recorded on a separate line within the sales journal. We are showing the accounts that are affecting accounts receivable and sales revenue, because recall, every time we sell inventory, there are two journal entries. We debit accounts receivable, credit sales, and then we also debit cost of goods sold and credit inventory for the cost of the goods sold. Here we are seeing both journal entries for each sale that was made during the month. However, instead of recording each individual sale into the general ledger, we wait until we get to the end of the accounting period. Here it was for the month of May, and we would just record the total. We would total the $90,230, debit it into accounts receivable, and credit it to sales revenue. We would take the total of $62,190, debit it to cost of goods sold, and credit it to inventory. This ends up only recording one journal entry for each of these, as opposed to 1, 2, 3, 4, 5, 6, 7 separate journal entries for each of these, thereby reducing the number of entries made into the general ledger. As these transactions are recorded in the appropriate column here, we are also updating the subsidiary ledger at the same time so that the customer's account is always up to date. The journal entries in the sales journal really end up one line entry for each sales transaction, saves time for the accounting department. Only the totals rather than the individual entries are posted to the general ledger, and we are able to achieve a division of the labor. The cash receipts journal would be very similar. I'm not going to go through the details of these transactions, but we are seeing all the transactions that involved the receipt of cash for the company during the month. And what we are seeing is one line for each transaction. And that transaction is showing that for every one of these, cash is going to be affected. Here we're seeing a cash receipt debited to cash, increasing cash. And then we have various columns for the appropriate accounts that are credited. Which account is credited depends on what the transaction is. At the end of the month, we would only post one debit to cash as opposed to 1, 2, 3, 4, 5, 6, 7, 8 debits to cash. And then we would just record the total into the appropriate account for the credit of the transaction. Okay, we're seeing updating of the accounts receivable subsidiary ledger when cash is received from customers to keep the customer accounts up to date. And we're also seeing at the end of the month, only one transaction recorded into the cash account as opposed to multiple. The purchases journal would work very similar. For every purchase on account, we would reflect the creditor that we owe or the supplier, along with the amount that is debited into inventory and credited into accounts payable. Regularly updating the accounts payable subsidiary ledger so we know exactly how much we owe to who, but the total dollar amount of all purchases on credit is only debited to inventory and credited to accounts payable once during the month. The cash payments journal is very similar. Here we are seeing every transaction that involved the payment of cash, noticing that the cash is credited for every transaction because every transaction involves the payment of cash and a credit to cash, and then the appropriate account that is debited depending on why the cash was paid. Again, totals are posted to the general ledger once as opposed to multiple times throughout the period. Again, we are updating accounts payable subsidiary ledger as payments are made, reflecting payments on accounts payable. Here is a visual of the totals being recorded into these accounts only once as opposed to multiple times throughout the month.